Cash versus accrual accounting. When creating accounting systems for a business, one of the decisions that needs to be made first is whether to use cash or accrual basis accounting. The difference between the two methods is the timing of when transactions are recorded in accounting. Timing. With cash basis accounting, revenue, that's money coming in, is recorded when cash is received from customers, and expenses are recorded when cash is paid out. With accrual basis accounting, revenue is recorded when the sale is made, whether or not the cash money is received from customers. Expenses are recorded when they're incurred, whether or not the cash money has been paid out. Let's check out some examples. So let's say the transaction is that the business makes a sale of a product for $100 on January 1st. But the customer doesn't pay on January 1st. In many business transactions, the customer is not required to pay the moment they make the purchase or receive the product. Sometimes they're given some time to pay. So in this case, the customer paid 1 month after they actually purchased the product. So in cash basis accounting, the $100 sale would be posted in the accounting on February 1st because that's the day that the customer paid. Even though they had the product a month earlier, they didn't pay until February 1st, so cash basis, you record it on February 1st. With accrual-based accounting, you record the transaction when it happens, regardless of when the cash changed hands. So in the accrual-based accounting, the $100 sale is posted on January 1st, which is the actual date the sale was made, and you'll do a second post on February 1st when the cash is received. So accrual-based accounting in this example provides a more accurate representation of what actually happened. The customer ordered the product, received the product on January 1st, but did not pay until February 1st. 2 transactions recorded. Whereas in cash accounting, it only records the change in the cash transaction. Let's look at the second example of our office chair. Purchase an office chair for $50 on January 1st, but you do not pay for the office chair until February 1st. So in cash basis accounting, you post the $50 payment as an expense on February 1st because that's when you actually paid the cash. With accrual-based accounting, you post the $50 expense on January 1st because that's when you purchased the office chair, and you make a second post on February 1st when the cash is actually paid for the chair. And when I say cash, that could also refer to a check or a wire transfer. It's not necessarily actual bills and coins. Could be, but it's not always. So cash basis accounting is simpler. It's got one transaction, perhaps where there's 2 with accrual. You only have to focus on when the transaction is actually made. But cash accounting doesn't give as accurate a picture of the company's current financial condition. This is because revenue may be earned on a particular date, but this will not be reflected in the accounting until the cash is received. Similarly, a company may owe a debt that may not appear in the accounting until it's paid. So in the example of our chair, we have a debt of $50, which doesn't even appear on our accounting system until we actually pay for it. So accrual basis accounting is the standard practice for most businesses, except for some very small businesses. BusinessXP is the fastest and most inspiring training ever invented for future business leaders and entrepreneurs. Discover game-based experiential learning at business-xp.com.